Welcome to Stat Plus, where we bring you smarter conversations on global trade, economic policies, and market trends. U.S. President Trump's recent memo directing his team to investigate reciprocal tariffs has created market uncertainty. However, it's important to note that this is not a new tariff announcement, but rather an initiative to study what duties trading partners charge for United States exports and explore options to match them with equivalent import tariffs, sector by sector. This move likely represents another negotiating tactic aimed at addressing the United States trade deficit with various nations, including India. Evidently, the Trump administration appears focused on securing new markets for United States oil and gas resources, which they plan to export more of in the coming years. India has already signaled its intent to increase energy imports from the United States, potentially reaching $25 billion annually, up from around $15 billion last year, with the United States-India trade deficit reaching approximately $45 billion in 2024. Increased energy imports alone could reduce this gap by about 25%. Additional defense equipment imports could further narrow it by another 25%. Analysis of the total bilateral merchandise trade between India and the United States reveals three distinct segments. The first is predominantly India to US. This segment accounts for 35% of total bilateral trade. This segment mostly includes finished goods exports to the United States. Many of these finished goods are actually exported by American companies operating in India, such as Apple's iPhones and Ford's cars. Any tariff increases here would likely be passed on to United States consumers, since demand for these goods is strong at the moment. If prices of these goods increase, inflation would surge and demand levels would drop, something the United States cannot afford as it would adversely impact their economy. The alternative for the United States would be to manufacture these goods domestically, which remains cost-prohibitive, even for American firms. The second trade segment is predominantly US to India. This segment accounts for 28% of total bilateral trade, dominated by strategic sectors like oil and gas and defense equipment. Represents areas where the United States seeks to increase market share rather than restrict trade. United States exports in this segment could rise, helping to reduce the trade imbalance, particularly with India's commitment to increase energy imports. The third trade segment is balanced or overlapping sectors. Segment accounts for 37% of total bilateral trade. Includes sectors like pearls and precious stones, iron and steel, aluminum, and chemicals, where trade flows are significant in both directions. These sectors are primary candidates for reciprocal tariffs. However, even here, practical constraints exist. Take aluminum, for example. While the United States has already imposed 25% tariffs on all aluminum imports, their smelting capacity is just 1.73% of the global total. Therefore, higher tariffs could be counterproductive in the long run. Moreover, significant aluminum recycling activity happens in India, a crucial part of the supply chain that the United States would not want to disrupt. And therefore, India may be able to negotiate concessions on this front. Any tariff impacts, if at all they come through, would likely be partially absorbed by currency adjustments, with the rupee-dollar exchange rate acting as a natural stabilizer. India's best strategy is to wait and observe how negotiations unfold, and investors should maintain composure during this period of uncertainty. What's your perspective on this trade policy shift? Should India take a proactive stance or wait to see how negotiations evolve? And how do you think this could impact investors? Share your thoughts in the comments. We'd love to hear from you. If you found this video valuable, don't forget to like, subscribe, and hit the notification bell to stay ahead of the latest developments. Stay informed. Stay ahead. See you in the next video.